Most European investors are paying higher ETF fees than they need to. Over decades, that can add up to losing hundreds of thousands of euros in potential returns. Money that should be working for you, not going to fund issuers. Here's a shocking example. If you invest 100,000 euros in an ETF with a 0.2% expense ratio versus one with 0.05% in fees, after 40 years you'll have over 115,000 euros less wealth, assuming an average annual return of 8%. Yes, that seemingly small 0.15% difference in annual fees could cost you more than your entire original investment after 4 decades. Since competition among ETFs in Europe has really heated up, it's worth knowing which funds actually have the lowest fees right now. Otherwise, you risk leaving serious money on the table. But here's a twist most people don't realize. The reason some ETFs can offer dramatically lower fees has almost nothing to do with scale or efficiency and everything to do with a single hidden cost. If you're new here, my name is Angelo Colombo. I've been investing in ETFs with my wife for over 8 years with the goal of achieving financial independence and maybe retiring early one day. Today, I'll not only show you the ETFs with the lowest fees in Europe right now, but also reveal the secret weapon that allows some providers to undercut the competition and why they're likely to keep that advantage going forward. So let's start with that hidden cost, because once you understand it, everything else will make perfect sense. The secret weapon behind many ultra low fee ETFs, like the global Amundi Prime All Country World ETF that was launched last year with an expense ratio of only 0.07%, which significantly undercut the competition, isn't better technology or economies of scale. It's actually about index licensing fees. Let me explain because it's crucial to understand. ETF providers pay MSCI, FTSE and S&P a small percentage of their fund's size each year as a licensing fee in order to track their indexes, for example the MSCI World, FTSE All-World or S&P 500. This licensing fee is usually in the range of 0.02 to 0.04% per year based on what I was able to find online. MSCI, for instance, seems to be charging about 0.0243% on average right now, according to their latest earnings report. So as a fund grows, the licensing costs grow with it. They're essentially paying a percentage-based rent for using these famous indexes. Well, here's where a new player comes in, the German index provider Solactive. Instead of charging a percentage, they charge a flat yearly fee, regardless of how large the fund becomes. So with Solactive, an ETF pays the exact same amount whether it has millions or billions in assets. According to an ETF.com article from 2021, this yearly flat fee starts at only $10,000 per year for a standard market cap weighted index. Based on that amount, an ETF only needs to reach $42 million in assets under management to break even, compared to the average MSCI index licensing fee, with zero extra licensing costs as it grows further. Even with a flat fee of $30,000 per year, it already reaches break even at a fund size of $125 million. To further illustrate this, the Amundi Prime All Country World now has $3.1 billion in AUM between its two share classes, distributing and accumulating. At this size, and assuming a yearly licensing fee of 30,000, this fee is basically already non-existent in percentage terms and in comparison to the 25 times larger fee they would have had to pay MSCI for a similar index. So as you can see, this is a major advantage, enabling some ETFs to undercut the competition so dramatically. And here's the kicker, because the flat fee doesn't rise with AUM, these selective-based ETFs could even lower their total expense ratios further as they grow. Now that you know the secret behind some of these ultra-low fees, let's dive into the actual ETFs you can invest in today. For example, using my favorite low-cost brokers in Europe, which I've linked down below if you'd like to support me. I'm going to focus on the major building blocks most European investors are looking for, but with some important filters. First, the ETF needs to have at least 200 million euros in assets to avoid closure risk. Second, they need to be physically replicating, which means they actually hold the underlying stocks. And third, they need to be accumulating versions, since these have significant tax advantages in most European countries. Let's start with global ETFs, which aren't only made up of developed markets, but also include stocks from emerging markets like India or China, for example. Since nobody knows what the future holds and which countries' stocks are going to perform best over the coming decades, in my opinion, a global ETF is the ultimate set it and forget it solution. Unsurprisingly, this is how my wife and I like to invest as well. At only 0.07% per year, the Amundi Prime All Country World, tracking the Solactive GBS Global Markets Large and Mid Cap Index, is the clear winner here when it comes to fees, followed by the Spider MSCI All Country World and the Invesco FTSE All-World. My wife and I have been exclusively buying the Invesco ETF since summer last year because of its lower fees compared to Vanguard, and because it's also been very tax efficient in Austria so far, something that's completely irrelevant if you're based in any other country. But honestly, we'd be happy holding either one of the three ETFs, and they're very likely to perform very close to each other over the long run, just as they have so far. You can also see this on an index level the past 5 years, where the MSCI All Country World had a slight edge, but the difference on average was still minimal. And before you ask, there is no reason to be concerned about the accumulating Amundi ETF's smaller size of 230 million euros, since their fund as a whole is already over $3 billion in assets, and that's the only number that matters, not how assets are split among the distributing and accumulating share classes. Now, if you want to include small cap stocks as well based on their market caps around 10%, the Spider MSCI All Country World investable market with a total expense ratio of only 0.17% is the easiest and least expensive way to do that within a single ETF. But maybe you're just looking for a world ETF covering developed markets, where the competition in fees has really heated up lately. The Amundi Prime Global, covering the selective GBS developed markets large and mid cap index, remains the cheapest option with a total expense ratio of 0.05% per year. That's 1/4 the yearly fees compared to the popular iShares Core MSCI World ETF. It used to be at a disadvantage compared to other world ETFs due to its domicile in Luxembourg, but Amundi fixed that mistake by moving it to Ireland at the end of last year, which has lower withholding taxes on US dividends. While the change in domicile resulted in a tax nightmare for investors from some countries like Germany, long term the move does make sense for the fund's performance. But luckily for us, the competition isn't sleeping, with UBS recently lowering the cost of its MSCI World ETF to only 0.06% per year, turning it into the lowest fee MSCI World ETF by a significant margin. On an index level, the selective GBS developed markets and MSCI World have once again performed very close to each other over the past 5 years, with the MSCI World only winning by an average of 0.07% per year. Now, what if you want to bet bigger on emerging markets, overweighing stocks from fast-growing economies like India, China, and Brazil, over the 10% emerging markets currently make up in global ETFs based on their market cap? Or if you want to add them to a world ETF and build your own global ETF portfolio that way with more control. While the Amundi Prime Emerging Markets looks great from a cost perspective at only 118 million euros in AUM, it's still too small in my opinion to count as a long-term option, which is why we won't waste time comparing its underlying selective index performance yet. This leaves us with the HSBC MSCI Emerging Markets as the lowest cost option at 0.15% per year, followed by two iShares ETFs. Sadly, even with its lower fees, it still underperformed the other two. Emerging Markets ETFs tend to have higher index tracking difference in general, so it's not as clear-cut as just looking at fees here. I'd personally pick the iShares Core MSCI Emerging Markets investable market if given the choice, not simply because it did the best among the three even on an index level, but also because it includes small cap stocks as well, giving you an even broader exposure to emerging markets. Alright, let's talk about the category that still dominates European investing: ETFs covering only US stocks via indexes like the S&P 500. These are some of the biggest ETFs in Europe. In fact, did you know that 4 of the 6 largest ETFs by AUM in Europe cover the S&P 500? We essentially have 2 ETFs battling it out for the lowest fee spot right now, both with expense ratios of only 0.03% per year: the Spider S&P 500 and the Amundi MSCI USA. The MSCI USA is actually a bit broader, containing about 544 stocks right now compared to the S&P 500's 500 stock limit. As for which index performed better the past 5 years, you may be surprised to hear that the MSCI USA actually slightly outperformed on average. But once again, the difference is likely going to be minimal over the long run, so pick whichever index you prefer. On the flip side, maybe you want everything except more US stocks. Or you want more control over how much you allocate to stocks from the rest of the world. To accomplish this, the MSCI World X USA by X trackers or the new one from iShares at 0.15% per year seem to be the best low-fee options right now, since the UBS ETF is still too small at only 53 million in fund size. Sadly, we don't have global ex-US ETFs in Europe yet, so keep in mind you're going to be limited to developed markets here. And finally, let's talk about ETFs exclusively covering European stocks. You may be looking for these if you want to increase your exposure to Europe beyond its current market share in world or global ETFs. Here, Amundi has once again tried to push fees as low as possible, with the Prime Europe covering a selective index. But since it's still quite small, I'm going to exclude it for now. I'll still show you its index returns afterwards in case you're interested. This leaves us with the Amundi Stocks Europe 600, the Vanguard FTSE Developed Europe, and the Amundi MSCI Europe. If I had to choose, I'd personally go with one of the first two, not only based on fees, but also because their index is a bit broader compared to MSCI. And looking at each index side by side over the past 5 years, the FTSE Developed Europe slightly outperformed on average, but they were once again very close to each other. Now, Now, I've been very critical of Amundi in my past videos because of all their fund mergers and fund domicile changes from Luxembourg to Ireland, which were a tax nightmare for some European investors, for example, in Germany. Having said that, if your Amundi ETF containing US stocks is already based in Ireland, you should be able to rest easy, as you're likely safe from changes in fund domicile. My only remaining concern is that based on their past behavior and because Amundi is based in France, they may want to change an ETF's index to its ESG version down the line. But I'm really hoping that won't happen now that some of its prime ETFs have gotten so large. I do have to give them a lot of credit for how they've now positioned themselves in the ETF space, pushing fees as low as possible, oftentimes significantly undercutting the competition. This is great for us, as it forces other fund issuers to cut theirs as well if they want to continue attracting investors. After looking into it in detail, their move to Selective as an index provider, instead of using FTSE or MSCI for their prime ETF series, does make a lot of sense, since it enables them to basically save 0.02 to 0.04% in yearly licensing fees once an ETF reaches a certain size. I also have to give Selective credit for its revolutionary business model, but seriously, who approved these index names? For example, why can the Selective GBS Global Markets Large and Mid Cap simply be called the Selective Global? Kind of reminds me of how bad Sony is at naming their products, like my favorite headphones, the Sony WH-1000X-M5s. But joking aside, let's talk about something more serious. Before you rush to switch all your ETFs, hold on. There are a few important things that could save you from making an expensive mistake. Fees are important, but they're not the only thing you should be looking at. It's true that they're the only part of investing you can actually control, since there's no way to know ahead of time what your returns are going to be in any given year. When you have ETFs covering the same index, the lower fee option is likely to outperform long term, but when they cover different indexes, you can't know for sure, since the index composition is likely going to be slightly different. Having said that, the ETF you choose should still have a good tracking difference on average. Otherwise, a slightly more expensive fund could still end up ahead if it tracks its index more closely. Also, don't forget about taxes, so don't switch from one ETF with the same strategy to another one due to lower fees, as a small difference in yearly fees is unlikely to make up for all the taxes you would need to pay by realizing capital gains early. Instead, hold on to your existing shares and simply start buying the new one in case there is another one you like more. That's exactly what my wife and I have done since 2018. We're not selling any older shares that are in profit until we actually need the money, for example in retirement. And generally speaking, I want to clarify that this video is not meant to incentivize you to switch ETFs. While a lower expense ratio can compound to a nice amount over decades, it's not going to make or break your investing strategy. I simply wanted to make you aware of the lowest cost options that are out there right now, so you can make a more informed choice with your money. Are you holding any of the ETFs I mentioned today? I'd love to know in the comments. As usual, you can find my favorite low-cost brokers in Europe for ETFs linked down below, which is a great way to support me if you'd like to. I'm also going to add all the funds I mentioned today and their ticker symbols there so you can find them yourself. And in case you missed it, you need to watch my video on the 6 wealth levels every European must know next, as a strategy that got you to your first 10,000 euros might be completely wrong once you have 100,000 euros or more. I think it's one of my best videos so far. Please don't forget that none of what I mentioned today was meant as investment advice. I'm just openly sharing my personal opinion based on my own experience as an investor. Thank you guys so much for watching. Have a wonderful day, and until next time.